The Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. The Sure Investing Podcast is hosted by Nick McCullum and supported by Sure Dividend, an investment newsletter provider aimed at helping people invest better through low-cost, long-term positions in individual securities. All opinions expressed by Nick and podcast guests are solely their own opinions and do not necessarily reflect the opinions of Sure Dividend. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. For more information about Sure Dividend and the research our firm provides, go to www.suredividend.com/research. Hey everyone, today's conversation is with Jack Vogel, the CFO and CIO of Alpha Architect, a quantitative factor-based investing firm that invests client money using empirically verified strategies like the value effect and the momentum effect. Jack has a PhD from Drexel University and has an interesting mix of an academic's knowledge and a practitioner's experience. What really stands out about this conversation is his intellectual curiosity and his commitment to do the right thing for his customers, which means compounding capital at high rates on an after-tax basis over long periods of time. Our conversation is wide-ranging and discusses everything from behavioral finance to security analysis to his firm's research methodology. Please enjoy my conversation with Jack Vogel. So I guess first off, I just want to give you a big warm welcome and thank you for taking some time to be on the podcast. You guys run a quantitative firm, and when most people think of quantitative investing, they're going to picture a group of PhDs running HFT algorithms until they turn blue in the face. So I know what you guys do is different than that. So I thought we could start by just talking about what Alpha Architect does as a firm and how it's different from most people's perception of quant strategies.
Yeah, well, first off, thanks for having me on the podcast. Happy to help out with education efforts here. So what Alpha Architect does is, we run mainly systematic strategies. We started out 2010. We're mainly a consulting firm for a big family up in New York City. Did a lot of research on a ton of strategies. And then we went down the route of building systematic factor-based strategies. The three main factors we invest in are the value factor, the momentum factor, and then the trend factor. And so you had a good point there about quantitative investing and quantitative algorithms, and that can mean, a million things. So, what do we do? Well, I'll give you the simplest example is value investing. And most value investors who are trained in schools and whatnot, they're told to dig into the fundamentals, where you want to dig into 10Ks, statements from the CEO, try to figure out really what's going on with the company. And what we try to do quantitatively is basically say, listen, we are going to attempt to do some security analysis, similar to how everyone gets trained in business schools, but we're going to do it with a computer to kind of facilitate like a bottoms-up security analysis. And the reason there is we just at the outset know, first off, that there's two reasons to do that. One is, first off, there's a ton of data that one can collect, and you can spend probably an entire week on one company. But, where does that 1 week of companies research fit into the whole macro of all the stocks in the universe? So we use a computer to help build the screens to help us essentially take all that information and then filter to certain stocks that we like. The secondary reason that we do that is it also helps you to minimize, your own behavioral bias that can become embedded in the process. So, if you're doing a bottoms-up analysis, trying to figure out, what's the fair price of a security, at some level, you have to put in like a discounted cash flow number, and that's just, some number based on, weighted average cost of capital. But at some level, that number is arbitrary. I think everyone would agree with that. And there's all the research showing that behavioral biases can become embedded in there. So we kind of take it out, and that's why we use a program and an algorithm to help us pick our value stocks.
That's interesting. I really want to dig in and hear about, I guess, how you measure quantitatively these different trends. So, everyone's got their favorite metric of value. It could be market to book. It could be shareholder yield. It could be even just something as simple as dividend yield. So would you mind going through, I guess, each of the three factors you guys track and say, what are the quantitative signals you guys use to capture that effect in the market?
So for value, what we use as our main screen to the cheapest securities is we use enterprise multiples, which is just EBIT over the total enterprise value. One of the reasons to use total enterprise value as opposed to market cap is you can embed, what it would take to buy the entire company. So it's For those who don't know what that means, enterprise value it's the market cap of the company plus the debt of the company and then minus off cash. There's some other minor details, but those are the three main factors. And the reason you subtract cash is, if you buy the entire company, you, for all intents and purposes, get the cash back. So we use enterprise multiples. Again, there's a lot of other measures that people use. You mentioned a few like shareholder yield, PE, price to book. You could also use a average of those measures. We're just fans of the enterprise multiple. We think that's kind of how an outside like PE firm would think of firms. So that's the one we use. And then historically, that one worked well. Our sample was 1970 to 2014, but out of sample, actually, that one didn't work as well. But we're still going to stick with it, and that'll happen over short time periods. And then for momentum, we use an intermediate term momentum score, which is we look basically at the total return over the past 12 months, and we ignore the last month. And that basically, so if you have 1,000 stocks, we would then sort all securities on their total return over the last 12 months, ignoring last month, and we would get down to the top 100. And then from there, we get down to 50 based on the quality of momentum score. And then on our trend factor, we tend to use our longer term trends, which are 12-month moving average and 12-month time series momentum. So I'll stop there and let you see if you have any clarifying questions.
No, that's all very clear to me. I'm curious, what you guys do this exclusively in the United States, or you take a global focus as well?
So we do this both in the U.S. and in international stocks, as well as indices. So we actually do both. We currently don't do it in emerging markets, but that's just a business decision at this point. That's what I would say.
And in terms of when it comes to portfolio construction, do you guys have, say, you have a portfolio, is it divided into three sections? There's a value section and a momentum section and a trend following section, or do you blend those three screens together for the selection of each stock?
Yeah, that's a great question. So is the question mainly, how do we combine value and momentum at a portfolio level or at a stock selection level?
I guess both, mostly when it comes to portfolio construction, though.
From a portfolio construction level, again, not security selection, what we generally do is we say, hey, it's like 50-50 value and momentum. One could arguably risk parity weight across them, which we actually do in one of our strategies. And what that does is it essentially will overweight value slightly relative to momentum. Because, when you risk parity weight two long-only equity strategies, such as value and momentum, what you'll see is that momentum just generally has a higher volatility than value. But at the portfolio level, we kind of will argue that a 50-50 allocation to the two or a risk parity based allocation is a good way to go. And then at the security selection level, the details of if you wanted to blend the two together there, the sequencing would matter. Obviously, you want to do value and then momentum. Generally, just doing momentum and then value doesn't add too much. And I think at the margin, a 50-50 screen or a 50-50 portfolio of separate value momentum ones will probably end up around the same area as using value momentum in a blended security selection portfolio.
And then I guess just talk about how you guys offer these portfolios to investors. I know you guys have some ETFs, and I suspect you guys do separately managed accounts too. So what are the different ways that an investor could capture these effects working with Alpha Architect?
What we currently have is we have 5 ETFs, and basically the 2 of them are value ETFs. One's US, one's international, and then 2 of them are momentum ETFs, one US, one international. And so each of those ETFs, they're long only ETFs. They hold 40 to 50 stocks, and they're equal weight, either to the value or the momentum factor, and either in the U.S. or international markets, right? And so those are for people that are looking for, basically value or momentum exposure. We do it in a more concentrated fashion. As I mentioned, 40 to 50 stocks equal weighted. Then I would say a lot of other options out there in the market. And then the 5th ETF combines everything. It's our value momentum trend strategy. And what that does is it holds the 4 underlying ETFs that are long only. So those are QVAL, IVAL, QMOM, and IMOM. It holds them as your baseline portfolio. So basically, if you look at U.S. and international stocks at the outset, mid large cap, you have around 2,500 stocks. It is pretty accurate number around there. So if you hold those 4 ETFs, basically of the 2,500, we're going to pick around the top 100 on value and around the top 100 on momentum. So you're going to have a 200 stock portfolio, around 50 US, 50% international. And then the third aspect, which is the third factor we like, is a trend following component. And what we do there is every month we assess a trend rule on either the US market like S&P or international developed markets such as the EFI index. And if the trends are positive, we stay long only. If the trend in either or both of the markets go negative, we will actually hedge, and it'll become either partially hedged or up to fully hedged. So that's, I would say, those are the ETFs we have, and then that's I would say the main way most people work with us. We do have managed accounts, but a lot of it's derivatives of those products.
It seems like most of your offerings are in value stocks and momentum stocks. How do you think about the diversification benefits of owning both value and momentum strategies?
Yeah, so obviously, when people talk about value and momentum, right? One notices that for long short portfolios, and this is what commonly gets touted and cited by many, right? Is that for a long short value portfolio and a long short momentum portfolio, what happens is if you run those two return sequences right next to each other, you see that they actually have a negative correlation, right? Which is awesome from a portfolio diversification benefit because, when you have a negative correlation, that means when one's doing well, the other one's probably doing bad and vice versa, right? And that's commonly cited by many kind of in, the marketplace. One thing I would say and caveat people is most people, when they try to access a value portfolio and a momentum portfolio, they're going to do it through a long-only investment product, right? And so it is important to understand that the negative correlation is only on the long short. For long-only portfolios, how most people invest, the correlation is not negative, and the reason is because both have market beta exposure. So they have a positive correlation. But one thing that is nice is that the two portfolios basically have a lower correlation to each other compared to their individual correlations to the market. So basically what happens is you gain this portfolio diversification benefit of holding the two value, like a value portfolio and a momentum portfolio side by side. Yeah, it's not the negative correlation unless you're doing long shorts, but it still is better because their correlations are lower than what they are with the market.
I want to also talk for a moment about your research process. So it's obvious you guys like value and momentum. I guess, how do you guys think about adding new factors to the strategies you guys already have?
Yeah, that's a great question. And so what I would say is that, we've obviously looked at a lot of the data, initially did a lot of research for family. And then, when you're investigating this for a long time, you kind of have to figure out, well, what factors do you want to invest in? Which ones do you want to stick with? And what we've come to the conclusion is that, from a long only perspective, we kind of are of the belief, and I think it's borne out in the data, that the two biggest factors on long only is value and momentum, right? So now some of the other factors that are both, in academic literature as well as in practitioner portfolios, we kind of use them within our portfolios. So common ones are like quality and low volatility, or like low beta, right? Those are other ones that I think most people know about. And so how do we use them? So for our value portfolio, what we do is, let's say we get down to around 80 to 100 stocks on our enterprise multiple basis for value, right? So we're already in the cheap stocks. What we do is we use a quality score to get down to the top, what we call 40 or 50 stocks. So we still embed the quality factor into our portfolios, but it's just not the main driving factor. And then for low volatility, right, we have what we call like a quality of momentum screen, where we go from our top 100 momentum stocks down to our top 50 momentum stocks. And how we do that is we try to look for, and the example I generally give is, imagine you have two momentum stocks. One is boring big box. That's up 100% because it's had a 50% return for 200 days. The other one's exciting biotech that, was up 0%. And then a month ago, it went up 100% in one day on an FDA approval, right? So those are like two vastly different momentum firms. They got their momentum in different ways, right? And we use kind of we call it a frog in the pan measure, but at some level, it's similar to a low vol measure to pick like the boring big box type momentum firms. So on our value screen, we use quality. On our momentum screen, we use low vol, but those are the quality and low vol screens are kind of secondary. They're not like the driving factor. And then at some level, we use like the size factor just in our portfolio construction. We equal weight across mid and large cap. So you get a little more access to the SMB or small cap exposure just due to the fact that we equal weight across our 50 mid to large cap stocks.
Can we dig in and learn more about your quality score? So there's all kinds of different ways to measure this, and a lot of them are empirically verified. I'm curious as to how you guys measure the quality of the companies you're screening through.
For our U.S. portfolio, I'll go through. I'll go through. Let's do the U.S. one to start. So for U.S., we kind of think of quality as like a table with you got legs on each side, right? So on the left side, what we do is we try to look for like long-term type moats, kind of like the Warren Buffett strategy of looking for firms that have moats, right? And so what we do there is we look at long-term free cash flow over assets over like 8 years. That's one of our measures. Another thing we look at is long-term return on assets and equity, again, over an 8-year period, right? And the reason to do free cash flow, ROA, ROE over 8-year period is to say, okay, maybe a firm, is burning cash slightly for a year or has a negative ROA, but over an 8-year cycle, they should have, positive returns on assets, equity, and then positive free cash flow. And then the secondary long-term measures, we look at margins, right? And so on margins, we look for one of two things. One is, you have the Procter and Gamble's of the firm. So we create like a Sharpe ratio of your margin over the standard deviation. So Procter and Gamble is like a great firm for like margin stability where they have a 50% margin with like almost no volatility over an 8-year cycle. And every single company in the world would love to have 50% margin and no volatility on it. But we also understand at the same time, some firms can actually increase margins. So we'll look at like margin growth rates and kind of take like the max measure on that. So that's kind of our long-term 8-year way of measuring quality. And then on the other side of the table, holding up, so that was holding up the left-hand side. Then holding up the right-hand side, we have what we call like our pre-flight checklist, which is we just want to make sure that these value firms, which clearly are cheap for some reason, that they're going to be around in a year. And so we look at like year-over-year measures. There's 10. It's a 10-point checklist going through certain factors like did you have positive cash flow last year? Did you issue new equity? And we outline all these, on our website. But it's basically a 10-point checklist where you get a 1 or a 0. And the reason we do that is to make sure that in the short run, the company's still going to be around the following year.
And how often would you say you guys find new ways to measure these quality scores or low vol scores or even the value and momentum effects that you guys are capturing?
I mean, we haven't changed our main screening algorithms now for some time. And what I'd say is that we could change it, and there's reasons to change. We kind of believe like the models were built, in our opinion, to be good going forward. Obviously, we always keep up on the research to make sure that we're not missing anything. But a lot of times embedded in the data, what you see is you kind of end up in the same general area anyway. So, a good example would be like the value factor, right? So on the value factor, if you just look at all those different multiples we went through, so like price to book, PE, enterprise multiples, we can argue back and forth which one's the best, which one's optimal, and depending on your sample, you can basically get different results. But I would say over like longer time cycles, like I'm talking like 20, 30 years, I think they're all going to be in the general area. So since that historically has kind of been true, that you generally are in the same area. You could be off 1 or 2%, but which does amount to a lot over a long time. But ex ante, I don't know which one's going to do the best. But since we know you're in the same area, we try to not mess with the model unless there's something super compelling that would require us to do so.
So it sounds like you guys are actively doing research, but not very often you guys find something that changes your approach to investing. And that makes me wonder, you guys are obviously very research focused. What's your approach to winning the human capital arms race that kind of naturally occurs in the field of quant finance and finance in general, actually? How do you find the best talent?
Yeah, that's a great question. But let me start with this. I think it's kind of important to actually distinguish and differentiate between trading and investing, right? So with trading, I would agree 100% with you that there's a massive arms race, whereby these HFT firms are just attracting PhDs, mainly in math, stats, and sometimes engineering. And they actually need to do that to win, right? Because they need to always be building better models, trying to get data faster to win fractions of pennies every nanosecond. And we know some people in that space, and we stay way away from that because that's not our expertise. We don't want to compete there. So, I would say that's probably the arms race most people think about. So I would say our arms race is like slightly different, right? Because we're talking about investing and trying to attract investors to potentially invest in our strategy. So we're looking for individuals and advisors, which is the same thing, DFA, AQR, what those guys are doing, that want to invest somewhat differently than the passive Vanguard iShare portfolio, right? So some use our products for small portions of the portfolio while others use it for larger. So for us, the arms race and really the key is just we're trying to find the right investors who understand our process and know why it can and also why it can't work. So here we're competing by trying to help educate on different factors, portfolio construction. And, like one thing we've done there is we're building out a new tool on our website, which you may have seen, the visual active share tool, to try to help advisors, individuals understand what's actually going on within ETFs and different funds out there. And so, our firm mission is like empower through education, which I know you're trying to do through this podcast, which is great. But we know at the outset that, and this has happened millions of times, sometimes we spend a ton of time helping someone out and they may just go to Vanguard or another competitor firm. But, we think in the long run, just being transparent, honest, which can even be at our own expense from time to time is one way to compete in the arms race, kind of through like an honest integrity type way of putting out our message.
Yeah, you definitely can't argue against that. Having good clients sounds like it's a really important part of your business. I'm curious, what does your ideal client look like?
Yeah, so our ideal client is mainly taxable high net worth individual. And just to give you a background, like I mentioned, at the outset pod here, that we started out as a consultant to a large family office, and the whole idea there, what we were doing is we were investigating tons of hedge fund strategies, and besides just value, momentum, simple strategies, we were investigating a lot of hedge fund strategies. And what happens is you start to understand that for a lot of these strategies, if you're a taxable individual, you're like, wow, that may be great, but if I have to pay 50% to the government every year, why don't I just buy like the index, right? And so what I would say is at the outset, we kind of started dealing with taxable investors and building all of our strategies, all of our philosophies mainly towards the taxable high net worth individual. So that's probably our ideal client because that's where we think we have the largest value proposition relative to other firms in the marketplace.
Now, you mentioned the taxable component seems really important to that. What makes Alpha Architect stand out for investors who are specifically looking to invest their money at an after-tax rate of return that's very appealing?
That's a great question. One of the reasons we went down, the ETF route as opposed to the mutual fund route, it literally goes back to taxes. So we were asked to solve a problem for a client a long time ago, and long story short, we couldn't do it, but it was a great problem the guy had. He had stock with very low basis, and it was about to be bought out with a cash merger. And he unfortunately had to pay taxes. But in our research, we came across the taxation of ETFs. And basically, what we learned is that through the in-kind creation and redemption mechanism that is available to ETFs but not available to mutual funds, one can tax efficiently, or say more tax efficiently, than a mutual fund, potentially rebalance your ETF to defer taxes out into the future. For our value and our momentum strategies, we knew at the outset that we were going to have turnover, right? So, Vanguard, it doesn't really matter if you buy the S&P 500, right? Because they're just basically buying the biggest stock. So mutual fund ETF with no turnover, it doesn't really matter, right? The minute you start saying, hey, I want to do value investing, great, right? How am I going to do it? Typically it's on a managed account, and we started that a long time ago. And when we were doing managed account strategy, what do we have to do? We had to do, the similar problem that I would say most advisors that are doing value stock picking do. They have to say, okay, I want to rebalance my portfolio here, but I need to wait a year and a day to get this stock out because I don't want to have short-term gains for my client, right? With the ETF, if done properly through the creation and redemption mechanism, you can actually do your rebalances, slightly more often and defer those taxes out into the future. So I would say the main way that we have a slight edge on some people, not everyone, is just through the ETF wrapper itself.
That is super interesting. I had no idea about the tax implications of ETF offerings. Another important consideration for your clients is, how can you find clients that are knowledgeable enough to want to invest in a factor-based quant strategy, but also trusting enough that they are willing to keep their hands off when your model goes through a period of underperformance, which is inevitable for even the best strategies, right? So I guess, how do you go about finding clients that meet those characteristics?
That's hard, and we kind of are taking the longer view on things, is what I would say. So how we do that is, a lot of times people will, just happen to stumble across our site because they read something, and they may reach out to us. And what we generally do now is we tend to say, hey, here's value investing. This is what value investing is from a 50,000 foot view, right? Then if you want to dig into the details, we can go into the very nuanced, painstaking details of why we do what we do. But then at the flip side, most people, if they're interested at the 50,000 foot view, they like digging in. And then a lot of times people will be like, oh, this is great. Totally understand, right? What we try to do is we also try to highlight at the outset to people that when you do a 40, 50 stock value investing strategy, you're going to have large tracking error from an index, 10% plus tracking error, which means from year to year, you can lose or win by a lot. So one way we try to get what you're kind of describing is what we call like sustainable clients. So one way you can get that is you can, at the outset, tell people why your strategy is going to suck, right? Like why it's going to, from time to time, not work. And I think people understand and appreciate that honesty and integrity. Because most of the time when someone's trying to sell you something, they're not going to tell you that at times it's not going to work, right? So we tell them that at the outset. And then the secondary thing is, to be honest with you, like we've had a lot of people that I've talked to, going back to the arms race question where I was telling you that sometimes people just go to Vanguard. And, there are a lot of times I personally send people to Vanguard. They may reach out, ask a lot of questions, and then be like, hey, I noticed your value strategy last month lost by like 2%. What happened? Like, is the system broken? And when someone asks that question, I would say 99% of the time that they're probably going to always be tracking it to an index. In which case, for them, the best strategy is to just go buy a cheap index fund. So I would say it's again hard to find those clients, and we potentially give up some, but we're trying to achieve or look for like what we call sustainable clients that understand our strategies may not work all the time.
It's interesting to interview different people in the financial world and hear their thoughts on this one-sided Vanguard trade where just billions and billions of dollars are going into Vanguard every month. Do you think that that's had a noticeable effect on the way that the markets function?
What I would say is I'm not sure, to be honest with you, on that question. Here's an interesting factoid though that I think is kind of related, right? So a lot of times people will be like, "Oh yeah, everyone's going passive," right? Like that's like a story that you hear in the news, right? Like, oh, look at the flows in the Vanguard, look at the flows into the iShares cheap S&P or total market fund, right? And I think this is kind of getting back to your question, like, is this changing how the markets work? Correct. And so one thing that's interesting is there's a paper by David Blitz. It's on our. We wrote a short summary on the paper, but he said, "Hey, let's look at every single active ETF or like factor-based ETF. So basically, non-market cap weighted, S&P or Russell 1000 index, and let's look at all of these funds and say, hey, what do they in aggregate come up to? Because a lot of times people get back to oh, what's the capacity on these strategies, etc. And they forget to say, okay, well, let's just look at in aggregate, what does everyone do, right? So if everyone was loading up on value, if you took all the active funds, you should see like a high HML or value load. Similarly, if everyone was loading up on momentum, you should see like a high momentum load, right? But the crazy part is when you look at all these assets in total, you literally get just a loading of around one on the market and nothing significant on any of the factors. So what does that mean? That means literally all of the active funds in aggregate are just given you the market. So yeah, while people are going to Vanguard, going to iShares for cheap beta, all that's probably doing, I don't know if it's changing the way the markets are working, but it's probably just changing the overall, economics, cash flow to more active-based strategies.
I just want to make sure I'm thinking about what you said right. So you said all the active managers in aggregate are basically a passive fund if you lump them all together. So with that in mind, this shift to Vanguard is really not changing how stocks are owned. It's just kind of changing their fee structure.
Potentially, yeah. And to be clear, I'm not 100% certain if I don't even know if I have a great answer to that. I don't know if new flows or flows to passive strategies are necessarily changing the way markets are working. But I will say that it is true that there was a cool study showing that yes, all the aggregate, and this was just for ETFs, not for mutual funds, but all the aggregate ETFs essentially just give you back the market, which is kind of crazy.
That is really interesting. You mentioned in your previous answer about capacity constraints. How do you think about capacity constraints with the strategies you guys implement at Alpha Architect?
Obviously, that's a question we think about all the time. So capacity constraints, and the question comes in with factor investing, and maybe the question you're asking or a derivative of that question is the kind of like, do factor investing portfolios survive transaction costs? And there's a lot of debate about that answer with people on both sides of the argument. We kind of believe that they do, but there definitely is a capacity constraint. And for as we think about it, like how do we think about it, right? Well, we can see in real time like the trading costs for our funds, including both commissions, bid-ask spreads, market impacts. So we are always saying, hey, we need to weigh the pros of portfolio rebalancing. So for momentum, everyone knows that the more often you rebalance in general, ex ante in the past on paper portfolios, that was better. But there's also cons, which are trading costs. So we always have to weigh pros versus cons. And for now, the way we build our portfolios, that will work for some time. But if you're saying tomorrow we have $10 billion in our momentum fund, just one fund, we're definitely going to need to change the construction. So I would say we think about it all the time, and I don't have a direct answer because it's going to vary across strategy. Like value and momentum, if we ever made a change, there's different ways you could do that. So value, maybe you rebalance less often. Momentum, maybe we have to stagger and do bucketing across mid large caps where we do a little bit more to large relative to mid, and same again across US and international. So there's no perfect answer there, and I think any fund manager would tell you that there's no like, it's not like a mathematical you can optimize on what's the best, but it would vary across the strategy type as well as US international.
Yeah, so I've never had the privilege of managing such a big sum of money, but if I were to hypothetically think about it, I would say, there's kind of four things a portfolio manager can do when they get huge inflows. They can either cap the fund, which is an option. And then there's three kind of continuing options where they actually do continue to accept new money. And you can move up the market cap spectrum, which you mentioned. You could have more diversification. So instead of owning the 40, 50 you guys own now, you could own, say 200. Or you can just accept that you're going to be trading with higher trading costs and you can just kind of eat it in your fund. So the one that you really didn't mention in there is owning more stocks. And I'm curious about how you think about diversification and why you guys have deliberately chosen to own, it seems like 40 or 50 is your magic number for all your funds.
Yeah. And so on that question, for, as you mentioned, we held 40, 50 stocks on the long only portfolio. And so, what are the benefits of diversification? So, for those going back, one thing is when you hold a bucket of stocks all together, if you put together a diversified portfolio, you can eliminate what's called like idiosyncratic risk or like single stock risk, right? And so all of the research, and people have shown this, is, if you hold around 30 stocks or more, you gain around 98 to 99% of the diversification benefit of holding a 1,000 stock portfolio, right? So from about 30 stocks and on, in general, you're going to have similar diversification benefits to a 1,000 stock portfolio from an idiosyncratic or just volatility-based measure. Obviously, at 30 stocks relative to 1,000, you may have different sector allocations, et cetera, which are different risks, but from just the way people think about it is from like a standard deviation perspective, you gain almost all the benefits. So why we do 40, 50 stocks is, we kind of think we want to be more concentrated, I think, than most funds out there. Generally, it's around, 200 plus stocks for factor-based funds. There's some that are around 100, which are good as well. But we want to give people more access to a more concentrated value or momentum security selection method. And then, we equal weight across those positions, which as I mentioned earlier, gives you a little bit more access to mid caps relative to just large caps.
You guys equal weight. What's your approach to rebalancing? Do you guys rebalance monthly or quarterly, or what's your rebalancing schedule?
Yeah, so within the funds for value, we rebalance quarterly in the U.S. and every 6 months internationally. And why the difference there? International trading is just there's a cost, right? So us as the manager there, we had to say, okay, we probably would want to do quarterly in both, but we know value at the outset is a more longer term strategy that you could rebalance out to a year, right? And or even further. But so we do 3 months for U.S., 6 months for international on the value. On the momentum funds, we do them every quarter. And the reason we do momentum every quarter internationally for momentum, whereas for value we do 6 months, is momentum is a more faster, more moving strategy that one needs to rebalance more frequently. And then on our trend rules, we apply them. So the trend rule is applied in the one fund VMont, that gets applied and assessed a month.
I want to switch gears here and talk about, why choose factor investing versus, say kind of a Warren Buffett pick individual stock selections and hold them for a couple decades, that approach. So, the obvious benefit is that it takes away the human aspect of investing. We're our own worst enemies when it comes to managing our money. We tend to sell low and buy high, which is obviously the worst thing you can do. For you personally, and from the perspective of your firm, how do you guys think about minimizing the behavioral biases and the psychological errors that tend to happen for investors who are even following a factor-based strategy?
I'll answer that two ways. One is that within the security selection process, one of the reasons we use a computer or quantitative investment strategy to come up with the stock names is we don't want to necessarily be looking at the names and being like, oh, we shouldn't put that in there. Because and it's true. Sometimes when we run our value screens, I'm like, oh man, we really, I don't even know why this stock's going in. But we just follow the model. So clearly, and that's probably good, right? Because in general, for value investing, it could be that the stocks are inherently riskier, which that's at some level that is, right? Like, we're a little bit overweight consumer discretionary, and there's probably a legit risk that Amazon, eats all those companies and destroys them. But there's also potential. Who knows that Amazon needs to it does so, but then it also needs, properties to make more shipping centers, which those retailers may have. So who knows? I don't know. But we try to limit our behavioral bias on security selection by doing it with a computer. And then as far as like for someone to be successful in our strategy, right? That's a secondary behavioral bias question. And I think how we try to help people succeed in our strategies is, and I mentioned this earlier, but by telling them why and how our strategies can underperform at times. And so what we then tell people is, hey, by the way, this is a good strat. We think it's a good strategy, but it may lose the market for a 5-year period, 10-year period. What are you going to do? And if someone's like, yeah, I don't care, I'm fine, I can live with it, I'm going to hold this for 30 years, then maybe for that person they have a larger portion of their portfolio. For someone who's like, they're on the fence, but they still want to invest in that strategy, we just tell them, hey, make it a smaller portion of your portfolio. So that's kind of how we try to help investors at the outset make sure that they win to the extent they're investing in our strategy.
What's your take on the unique individual investors like a Buffett or a Charlie Munger or a Seth Klarman who have shown an ability to beat the market over time? Do you think that, and I guess more broadly, under what circumstances do you think that individuals have the ability to outperform a factor-based investing model?
Obviously, it's probably the rule that, a model's and we're big fans of, and there's a lot of research out there kind of showing that, models generally beat experts. But as you mentioned, there are these outliers, right? Like there is the Buffetts of the world, right? And at some level, and who knows, Warren may just be running this great quant algorithm in his head that he hasn't told anyone about, which is probably what he's doing at some level. But I think in general, people are probably good, especially from an investment standpoint, not from like a human capital, like putting in their time trying to run a business. Obviously, that's a different thing, right? But from an investment standpoint, I think most people are going to be better off just doing some sort of either factor-based model or even just investing in the S&P, which is some level of factor-based model that just loads up on the market factor. I do think there's chances that people can potentially beat the S&P, but maybe that comes with an additional risk. So an example I like to give is kind of like real estate. Because a lot of times, a lot of people we've met that have made a lot of money, it's been in real estate, right? And you can make money in real estate because why? You can use leverage to basically defer taxes for a very, very, very long period of time, right? And if you do those two things and do well, you're going to end up with a lot of money, right? But if you really think about it, like the real estate investor, let's say that compounds at 12% when the S&P compounds at, let's say 10% or 9% historically, right? If you think about it, the real estate investor that did that and they spent a lot of time, worrying about these properties, let's say they have only 5, 6 properties, they probably ended up really just taking they really ended up taking more risk than the market, right? So your real estate investors just investing in individual properties that, who knows, like they may look like great properties now, but in 20 years, you don't know what's going to happen with demographics, of that individual location that you hold a property. So, you potentially can beat a model, beat the market, in like real estate, but it's probably because you end up really just taking additional risks that you may not be accounting for. And at the end of the day, that's, gets back to, the riskier the investment, the higher the reward. So I hope that answers your question.
Yeah, it definitely does. I want to continue on this trend of talking about kind of the big hotshot investors and just ask you, would you say that there's a particular investor who, through reading books or annual reports, or this could even be someone on a company management team, would you say that there's anyone who's influenced your investment approach in a big way that you kind of feel like has acted as a mentor? Maybe you've never even met them, but someone that you've learned a lot from?
One thing, and this is just now, I've had the luxury of meeting a lot of people that have been very successful in life. And one thing I would say that is common among those that did it is they generally found out a way to kind of like compound their wealth at some level in tax deferred manner. I would say that is probably like the most common attribute that all of them have, whether it's someone making manufacturing labels that did it through net operating losses, or someone who did it through real estate where you 1031 rollovers for 60 years. In general, those people, one of their common attributes is they figured out a way to kind of minimize taxes. And you can even argue Warren Buffett at some level, he didn't pay out dividends. He minimized taxes over, a 50-year period. I would say that's a very common attribute, something that I always keep in the back of my mind when making like any investment decisions is how can is there a way, or is it possible at all to do this in a tax efficient manner?
That's interesting. When I think about the stereotypical real estate investor, someone who's actually buying real properties, one of the things that stands out to me is that they seem to hate paying taxes more than they like making money. And you mentioned that earlier too, but that's what that comment reminds me of.
Yeah, and it sounds like you had a real estate person on before, but it is true, and there are those people that literally sometimes they'll figure they'd rather just not pay taxes as opposed to paying money. Sometimes I disagree there. I'd rather make money on an after-tax basis, but yes, that is common amongst the real estate investors.
I want to close up with a few more questions that are kind of in the fun bucket. The first is, you've talked about how the three most dominant factors in the market are value, momentum, and trend following. Let's say, there's a gun to your head. You have to pick one factor to follow for, say, the next 10 or 20 years. Which would you pick, and why would you pick it?
Yeah, I think it's obviously that's a tough one. I probably would end up having to pick momentum if I had a guess. One of the reasons there is just the fact that at some level you're just following the trend, and across everything in life, the more experiences you have, you understand like trends exist. Like in sports, teams do well for some time. In politics, a party wins for some time. In investing, some stock wins for some time. So I was a huge value fan at the outset, but I've become, I'd say, more of a momentum believer. Just the fact that doing it systematically, you're always going to be in stocks that just for some reason are doing well, and your brain may not be able to figure out exactly why, but the whole idea is just kind of following the momentum factor, which it's similar to the trend, but following the momentum of individual stocks is what I would say.
That's a great answer. My next question is about investment management, and I guess we talked about Vanguard, we've talked about AQR and DFA a little bit. If you had to give your money to one outside active investment manager for the same time horizon as my last question, so say 10 or 20 years, who would it be?
AQR is great. DFA does good things on the value front. I think AQR, I like because they do momentum as well. But I would say I probably prefer a firm that's like similar to like our size and just kind of similar culture. And just personally because I know them, which would kind of be like the Cambria guys like Meb, or the other ones like the Resolve guys up in Canada. They both kind of have different strategies, but similar at the same time. And I like what they're doing. So I'd probably pick one of those two. I'd probably just split it amongst the two firms there.
That's all I have for to talk about today. Thanks a bunch for taking some time to chat with me. It was a great conversation, and I'm sure our listeners learned a lot.
Yeah, well, thanks for having me on, and hope everyone learned something as well.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.